right, time to see what's on Paul Harris's radar right now. Paul's a portfolio manager at Harris Douglas Asset Management. And first up, First Service. Why?
Right, so First Service is a real estate company, but they manage real estate properties and they own these franchise things. So they own California Closets, Paul Davis. And so what I've liked about this company for many, many years, I've owned it for a long time, is that it's a very fragmented business still. Mm-hmm. So they grow by organic growth, but they also grow by acquisitions. And so although they're one of the largest players, they still don't own a very large percentage of the market. So that's one thing. I think that the other thing is that there's a slight annuity on the residential property side, simply because once you sign a deal with these people, you don't kind of switch every year, and there's an inflation increase each year on what they do. So you're protected. The stock has fallen a fair bit. You rarely see it fall at kind of buying it at these valuations. Mm-hmm. So it's always been expensive, but it's a great Canadian company. It's also very, it's a large part of their business is the United States. So I think that they kind of grow organically and grow through acquisition. And they've been very strong with acquisitions, not kind of paying up for everything they want. They really do have an acquisition strategy that really works well. So I like the story. I think you're buying it at cheap levels here.
And what's the mix of organic and acquisitions?
So it just depends on kind of the year.
Yeah.
But I would say generally sort of, you're seeing about a 10% kind of 5% organic and 5% acquisition growth. They're very specific about acquisitions. They may see something that may be, it kind of fluctuates between years depending on what they see on the acquisition side. But they're very good at sticking to their guns on the acquisition and not paying up, that's what's the important thing, because it is slightly a growth by acquisition story.
Okay. Next up is Zoetis.
Zoetis. Right. Zoetis is a animal healthcare company. They have two divisions.
Big business.
Yeah. So the first division is livestock, mm-hmm. which did poorly during COVID because there wasn't a lot of livestock work on livestock going on. But as you know, is as populations get wealthier, they tend to eat more protein. So livestock but it's a very kind of 5% growth business. Mm-hmm. The big business is the pet business. The pet business is huge. It's growing quite rapidly. The average cost of keeping a pet, not alive, but keeping a pet is about $3,000. Right?
A year?
Yeah, it's expensive.
Holy. Yeah. I don't know if I love my dog that much. I love my dog, but
so it's very
expensive a year.
Yes, very expensive. The other thing is that they become part of your family, so you do anything for them. There's not a lot of insurance. There is insurance for pets, but a lot of people don't do it. So a lot of things are out of pocket. There's not a lot of generic competition on the pet side on the pills. And also, when you look for drugs for pets, it's a lot simpler because they tend to use human drugs pretty much, mm-hmm. and bring them to pets. So the testing process is a lot shorter.
I was always astounded by that.
Yeah, it's a lot shorter, all those sort of things. So I think that's one of the reasons I like it. The pet business continues to grow. It's trading at one of its lowest valuations. It has a return on invested capital of about 24%. It has some great products coming through the pipeline. They've suffered a little bit because I think that this market sort of ran up very aggressively during COVID because everybody was just getting pets all over the place. And then it's kind of slowed down. But I think right now at these levels, it's really worth buying at these levels. I think you'll do well with it over the next couple of years.
And all those COVID pets are starting to get a little older.
That's right.
Okay, let's get one more in there. Adobe.
So Adobe is a stock we've owned for a while. I think the market feels that AI was going to be kind of a killer to Adobe.
Yeah.
But part of the problem with Adobe is that they kind of emphasized all their AI, what they're going to do in AI, all these kind of things, and overhyped their ability to do stuff. But this is a company that's sort of grown I think from $3.4 billion to $6 billion today in revenue. They continue to grow their top line between 8 to 12%. They bought back about 10% of their shares. To me, that's a real effective serial compounder. So I think, and you're buying it at one of the lowest valuations you've seen. I think AI will make a difference to them, but I think they as a company overhyped it themselves. Mm-hmm. And so they gave analysts sort of this idea that it's going to really change their business. And I think AI will change your business, but over a period of time, and there'll be stops and starts through that. And it will help them, but not in the way that they were talking about so aggressively. And I think that's what hurt them. But I think, and also they wanted to buy a company called FEMA, but the deal didn't go through. I think in this environment it would have probably gone through, but it was in the Biden era, so it didn't go through. And so I think that sort of set them back a fair bit. But I think moving forward, you're buying over a low valuation. I think the fact that they're buying back their shares, that they continue to grow their top line, and AI will slowly have an impact on their business and not take away from their business.